Hi there, wondering whether your wondering will be taxed at 18% or 24%? Let's explain how taxable income affects the calculation.
Two different people sell an investment property, each making a profit of exactly £60,000. But when the tax bill arrives, one owes over £1,300 more than the other. The reason has absolutely nothing to do with the property itself. It comes down entirely to their day job salaries. Helping you navigate this exact discrepancy is what we do at My Tax Accountant. We help individuals structure property sales, comply with HMRC rules, and keep more of their profits. This chart shows why this issue is catching so many people right now. Look at the annual exempt amount, the portion of your profit that is completely tax-free. A few years ago, it stood at £12,300. For the 2026-27 tax year, it has shrunk to just £3,000. That drop is dragging thousands of property sellers into the tax net for the first time. To calculate what you owe, you need to understand the stacking rule. For 2026-27, capital gains tax on residential property is charged at either 18% or 24%. The cutoff between these rates is a hard boundary at £50,270. HMRC takes your regular taxable income, the blue blocks here, and stacks your property gain on top. Whatever portion of your capital gain fits underneath the red line is taxed at 18%. When combined income and gains cross that threshold, the remainder is penalized at 24%. Your day job salary dictates exactly how much space you have left. Let's look at how this split calculation works in practice. In scenario A, we have a property seller earning a salary of £28,000, who realizes a £60,000 property gain. First, we determine their headroom. We take the £50,270 limit and subtract their taxable income. That isolates exactly £22,270 of empty space inside the basic rate band. Next, we apply the £3,000 annual exempt amount. We subtract that directly from the £60,000 property profit before any stacking begins, leaving a taxable gain of £57,000. Now we stack. The first £22,270 of that gain drops into the remaining basic rate band and is taxed at 18%. The remaining £34,730 spills over, taxed at 24%. Even though this seller earns well below the higher rate threshold for their income tax, the sheer size of the property gain pushes the bulk of their profit into the higher rate capital gains bracket. Compare that to scenario B. Here, the taxpayer earns a £75,000 salary and makes the exact same £60,000 property gain. Because their £75,000 salary already breaks right through the basic rate ceiling, there is zero space left. When their property gain is stacked on top, 100% of it instantly defaults to the higher 24% rate. If you live in Scotland, you need to pay close attention to this next point. Scotland has its own devolved income tax bands, but for capital gains tax, HMRC forces you to use the UK-wide £50,270 limit for your stacking calculation, completely ignoring your Scottish income thresholds. If your total taxable income exceeds that UK basic rate limit, the 18% capital gains tier is effectively erased from your tax profile entirely. You don't have the luxury of waiting until your January self-assessment to figure this out. HMRC enforces a strict 60-day reporting rule, forcing you to estimate your total income for the year, calculate the split, and pay the tax mid-year. That 60-day countdown clock starts ticking strictly on the date of legal completion, not the day you exchange contracts. Let's test your understanding. Pause the video here. If your salary is £40,000 and your taxable property gain is £40,000, how much of that gain falls into the 18% bracket and how much falls into the 24%? Here is the math. You take the threshold of £50,270 and subtract your £40,000 salary. That leaves £10,270 of space taxed at 18%. The remaining £29,730 spills over to 24%. Mastering this quick calculation is essential. If you underestimate your income and pay too much at the lower rate, HMRC will hit you with late payment interest on the shortfall. There is a legal way to manipulate these tax bands to your advantage. This involves making a qualifying personal pension contribution in the same tax year you sell the property. Every £1,000 you contribute to a pension extends your basic rate band by exactly £1,000. By raising that ceiling, you shift a matching amount of your property gain directly out of the 24% bracket and safely down into the 18% bracket. To wrap up, here are your 4 golden rules for 2026-27. First, your property gains stack on top of your income. Second, the threshold dividing the rates is £50,270. Third, always deduct your £3,000 allowance first. And fourth, you must report and pay within 60 days of completion. If you need help calculating your exact property gains or filing your 60-day report without making costly errors, get in touch with my tax accountant using the details on screen. Make sure to subscribe for more tax compliance strategies. Please note, this video is educational. Always seek professional advice before making any tax decisions.